Hello, investors and founders. Welcome back to Next Round Ready. I'm your host, Chris. Today we have special guest Andrew from Side Door Ventures. Andrew, welcome to the show.
Thanks for having me. Excited to be on.
So I like to start off my investor conversations a little different. Do you like being in venture capital in the startup world? Like, do you enjoy what you do?
I absolutely love it. I think it's the culmination of everything that I've sort of built up for the last few years. And I think that what I mean by that is I'm a five-time founder, so I've built and sold a couple companies. I've been on that side. And then being able to help founders, it's like a mental gym. So every time I sit down with them, it's like going into the arena, but you're not the one that has to battle. You sort of just draw up the battle plans, and you just sort of like, you've seen so many things. Like we see 8 to 10,000 companies a year. I've mentored at so many different accelerators, seen thousands of companies over the years. So I think this pattern matching is important because I think I'm often 80% of the way there off the rip. And I think and the last 20% is sort of just helping refine it to that specific business or that specific market or whatever. Often I can kind of get us in the right direction if they're not there already. I think that's the fun part. No one likes doing the heavy lifting. So it's nice that someone else is doing the heavy lifting, but I can just be helpful. Sometimes it's just a phone call. Sometimes it's building models, but that's the fun part. It's never the same. It's always different.
I got a bunch of questions now. You
Yeah, go
said
for it.
a five-time founder.
Yeah.
Like, how do you go from five-time founding? At what point did you say, okay, I just want to go to the venture side now?
It was kind of natural. I think I've actually been investing from the very beginning. So as I started making money, I didn't, when I made the first little bit of money when I was 19, and I wasn't really sure what to put my money into. And so I didn't trust stock markets, probably because I just didn't know them. I didn't understand how stocks worked. Like a stock could just suddenly overnight be worth 20% less because the market felt that way. But like the unit economics seemed the same. Like the business didn't change overnight. Like it felt really unnatural for me. Whereas operating things and building things felt very natural. That's where I felt like I sort of fit in the best. And so I think it was just sort of an evolution. I started investing in people around me that were building things. Now, my decision making on what to invest in was absolute trash. Most of what I invested in, was not good. But I think that's also a very natural journey for angel investors. Like you invest with what's around you. So your pool of deal flow is like whatever's surrounding you at that time. And I think as an example, that was you're investing in what's the best around you, not necessarily what's the best in the market. And I think that is a learning lesson I had to make over the years. To answer your question, I sort of been investing the entire time I was an operator. It just became more formalized over the years as like investments grew up and I made more money. As other people started asking me to invest money on their behalf, then you need a vehicle to do it. And so my story was really one where I had a family that really believed in me, and they, family office that believed in me as an investor, and they asked me to sort of get going. They said that they would bankroll $100 million for me to get going as a start, and I thought, okay, well, if I'm putting myself in the shoes of trying to make the most amount of money, it's actually not, in my opinion, having the largest size fund. And so I actually went a different approach. I said, if I don't have to fundraise a bunch, fundraising's not the issue. How would I actually maximize these dollars for returns? And I felt at the time that small funds returned higher multiples. And so I started a number of funds at the very beginning, all with a different focus. So we had, a fund focused on digital assets, a fund focused on pre-seed seed investments, a fund solely focused on late stage investments, a fund tied to YC as an accelerator, sort of ecosystem fund. I had these different fund products, all with the same LPs, but all had very different investment committees and different approaches, different fund like check sizes, different fund sizes. And so I sort of just built what I thought would be the optimal returns as a sort of stacked fund. So what that means for people is like when you have a small fund, you typically are you and one other person, and it's hard to do LP updates. Like those quarterly updates are a lot. It's hard to help every one of these companies. It's hard to build the sort of frameworks or the procedures that would normally follow a bigger fund. But if you have a bunch of these funds stacked together, you can sort of centralize all those operations and then just focus the investment component on each individual thesis. So we centralize a lot of our sort of LP update stuff, fund admin, like all the sort of, behind the scenes stuff is very centralized. And then the investment committees are sort of autonomous. and they'd make those decisions on each committee level. And then so each fund runs separately from each other, but they all have different theses. But these sort of LPs are generally across most of our funds.
And that's interesting because I've heard of something like that. And it makes me think on what your selection, your discernment skills have to be like to have several different funds at different stages, right? And still make good choices. So in the
Yeah.
beginning, you said your selection choice was trash. At what point did you have like confidence where you knew you were picking more winners?
Yeah, I'd probably say so when I first started investing, I think my first investment was 2006, 2007. Facebook, I was investing in Facebook games when Facebook was still EDU based and they didn't have, like, you could only talk to people on your own campuses.
Man, that's
It's like
old school right there.
pretty early days. And I was annoyed by that. So I was investing in a lot of ecosystem things kind of around what is now social media. At the time, it was called like digital media or online advertising. There was a bunch of new media was another term. And so I was investing heavily in those spaces. With that, I learned to hack a lot of platforms. So I was probably the guy you would go to if you, at that time, if you wanted to be on the front page of YouTube or if you wanted to somehow figure out how to beat the Twitter algorithms or, get exposure on Facebook. So I would say that that's one component growth, acquisition, especially with those, I'll call them hactics, like they're a tactic, but they're really a hack that has like a sort of window where they work. I learned much broader growth frameworks over the years and sort of and product-led growth, acquisition, advertising-led growth, all different types of growth strategies and sort of how they all work together. I think doing all of those over and over again helped me identify which companies would be best fit for those sort of accelerations of capital. And I forgot your original question.
But I like that the way you broke it down because it's essentially like if you have the frameworks and you know what it takes to win, it's almost like the legendary head coaches in the NFL. They know what it takes to win a Super Bowl after they win. And so that they can just get the same right players and the right coaches and put it together and they can just continue to win.
That's a great analogy. And also just determining like, if you think of all of the headwinds you face as opposition or defense in that analogy, then like what are the best structures or what's the best formation that you should be running in order to sort of penetrate or win that in that market. So in a lot of cases, for example, just pragmatic speaking, a lot of founders will try to do everything for growth. So let's say that 80% of their channel sales or their sales are coming from paid ads. They worry about that and then they start trying to do like user generated content or they get into B2B sales loops or they do these other things. And historically speaking, most large companies, 70% of their growth comes from one channel. So where I actually go the contrarian and I say, instead of trying to go broad, let's refine that one thing so it is completely efficient. But before we do that, let's focus on retention because retention is the silent killer. So do you have users that aren't churning? What are the mechanisms that get them to come back and have a sort of an emotional release inside the application itself? So what's the manufacturer trigger, environmental trigger? What are the things that get them time-based triggers? What are the things that get them to come back into the core function you need them to do? And then what's the payoff for those functions? So focus on engagement, not just retention of like, did they pay or not pay? And once you have the engagement and depth measured and that's actually where you need it to be, then focusing on all the acquisition things. So again, there's a hierarchy of where you start and what order they're in, order of operations. There's also like not trying to spread yourself and go to like to 6 different things when you should just focus on the one. So I think that's the operational side of me that goes, okay, this founder understands that or doesn't, or sometimes the founder doesn't understand it, but they've stumbled into the right path anyway. So it's just, do they align to me, with my view on how they're going to execute? Because every founder will tell you what you want to hear when they need your money.
That's
I think
so
not. They'll all agree with you, but like, will they actually do that at that moment? Like, who knows? Like when it comes down to it.
I have to ask now, if you have all these frameworks, like, and this is going to sound crazy, but I think people like you are the people, if I had to choose anybody that should put out courses and stuff and do the coaching, like you're one of the people I think that has that skill set. Because like you said, the framework from working with so many companies over the years across different stages, different sectors, it has to give you just an insane breadth of knowledge, like across the board of like all types of marketing, specific marketing things. Because what I run into a lot now, I work with a lot of accelerators, a lot of universities. It's a lot of the mentors who want to work with founders and things like that. And they kind of go with a one size fits all approach to every company. And I think that hurts a lot of founders in their success because this company may be in a different stage or a different way. The founder could be different. There are multiple reasons why you can't use the same framework for every single company, but that's just what I'm seeing a lot.
Yeah, I think it's fair. It's funny. I've been through myself 4 different accelerators. A lot of times I use the accelerators to galvanize the team around me so we all speak the same language as opposed to me needing the help personally. So most recently, my last company, I went through 500 startups. We were actually had already fundraised. We had already raised the seed round. We were kind of further along than I think most people would expect. I moved the entire team to San Francisco and we went through the program together so that they would all sort of be on the same page and sort of indoctrinate them on what the expectations were and how startups function. And we came from Vancouver. Everyone in Vancouver is kind of a live-work balance setup. So it was really funny. The first day hit and like 5 p.m. hits and they're all putting their laptops down, but nobody else in the cohort was leaving. And you could see them looking around confused, like, oh, are we leaving? Are we not leaving? And so, but no one wants to be the first one to go. So they slowly opened their computers back up and no one wanted to leave. But I don't think we left that night till like 9 or 10 p.m. And I just wanted them to understand that like someone out there is trying to eat their lunch, even if it's not in their immediate ecosystem. And like they're not competing like with the local startup down the street that isn't even in the same sector. They're competing on a global level, and people are working in this type of rigor to win. And we are in a dogfight because you're trying to survive and you're trying to make it. So I think it's really important that they understand that. And going through an accelerator, I came across a company who had some early product market fit signals, and the accelerator was really focused on acquisition and sales led growth. And I told them, like, you actually have a product that isn't fit for that. Like, I probably shouldn't have been their mentor, but I was the guy that was like, don't listen to any of these people. Like, all of these people are giving you horrible advice. Actually, what you need to be focused on is your retention and what's called branch factor. In their case, they had a bunch of people who were co-working. So meaning not like in the situation you would think like a co-working space, think doctors who work in multiple clinics. Oh. And I said, for you, what you need to do is offer it to the individuals because they will take it to those clinics and you'll be able to go up. And your average contract value doesn't support the typical B2B sales loop, which is what they're trying to force down your throat. I was like, I would ignore all of that and focus on product-led growth. And they did that. And today they're worth a couple $2 billion. And they're a huge success story. And I think it's interesting because I think it just highlighted in that market, that it wasn't San Francisco. And in that market, some of these tier 3 markets, they rely on these corporate people to be those mentors, or these sort of like business savvy people to be the mentors who just teach what they know that worked for them. And maybe to your point, haven't seen what works for that specific company, or the sort of, the factors or the assets that company has that they could leverage way better than others. And in that case, that particular company was extremely viral between their users. You could see retention. You could like in their data, you could see how a user would start with one, and then you'd see other doctors come online in the clinics that they worked in. And so it just became sort of obvious to anyone who did product-led growth that it could work that way. But if you were outside that system, you might not have recognized that. You might have thought, okay, we need a salesperson to go sell these clinics. And so again, just wrong. That format wouldn't have worked for them. There's this like no man's land and sort of contract value where people go to die from like 5 to 20,000. So you either are under $5,000 and you need self onboarding, or you're over $20,000 and you're white gloving the whole thing. And so if you fall somewhere in between, 99 out of 100 times you fail. Like that is like the worst zone for you to be in. And so for me, I guess recognizing where companies fit in that value chain and what types of sales they should do impacts what channels you pick, what their format, like what their sort of revenue model should appear to be. So you don't just look at like product market fit, but like how are they selling? What's their channel fit look like? What's the business model fit look like? And if you can put all of those in line, then you have a pretty good chance of winning. So I think just understanding that early and sort of making sure that the company is sort of like going that direction.
And I try to tell founders to learn a lot of these things like product-led growth and not just social media marketing. Because I think for me, I've studied things like product-led growth. So when I hear somebody like you talk about it, I know what it is and I'm not like lost on the entire conversation. And I think that's like where it starts, is that surface level knowledge. As a founder, it gives you a good foundation that you can build off of, so if you know all these things, you learn the basics across the board, then it's easier to choose. And I think that's why somebody like you can go and have 5 companies and be successful, because you learned all these different approaches instead of just, I know this one, I'm only going to do this one. Because sometimes you need the other stuff and you just got to know when to put it in there.
And know when it's not working, like I pulled the button. I say 5 times, I've probably failed more than that, like I have 5 that are people know. I have like another 6 that just didn't really work. So when you think about it, like, for example, I try to do 3D tomosynthesis with a radiology department at Yale, basically mammograms, but in mobile units that would go to sort of underprivileged communities or older communities. But it turned out in that particular case, there was a lot of hidden expenses in the hospitals that like weren't department by department, and so when you actually silo that business out, the margins were like less than 2%. So you can't have a sustainable business there. But at that point, we had already raised millions of dollars and were sort of like on the way to manufacturing custom trucks. So my point
Wow.
being, sometimes you just have to pull the plug because you know it won't work, as opposed to like beating that drum forever. And I think that's the hardest part, because you have this like sunk cost fallacy where you're like, I've already spent so much time in this, I need to execute
Just
it.
keep
And
going.
yeah, sometimes like the experience also is like just killing it, and I've killed a couple projects that I think probably could have made it, but I didn't have the bandwidth to fully operate it myself, or the pieces were just not clicking correctly, and I could see why, but I didn't have like a fix for that. And so sometimes you just have to pull the plug. So I say 5-time founder, but I've been unafraid to start lots of crap, and sometimes it doesn't work the way you expect, but that's okay. Like, just get out of it early. I view the first year as like learning. Like, I'm trying lots of different stuff, and if it goes, it goes. If it doesn't, if I don't feel that momentum and I can't see it, then I'm like, okay, then maybe there's another leverage point that I can use my time on. And I think that also is helpful, is like having one before, what it feels like when the momentum's with you, what it feels like when it's not with you. And so
Because I was going to ask how you measure that. Like, how do you measure that momentum? Because, like, this past weekend, I went and vibe coded a product on Lovable, put it together. And less than a week, I got my first paying user. Not even a ton of marketing, no real
yeah,
effort. And it's like, that's a win. I've also put together products before, and I've went and marketed it, and I've put money behind it in time. And then it goes nowhere after like 5-6 months. That one I felt like was better than this one, but this one is already making money. I have 3 more users today. So it's like, I do agree, when you haven't won, it's hard to like know what winning feels like, even on a smallest scale.
yeah.
That's, I think, the biggest question is always the product market fit and what that is, because it can look so different.
Yeah, I think, and it's different per business, right? So some of the hard tech stuff I've done, we might spend 2 years developing, like for example, I forget how many, probably 40 patents in high throughput blockchain processing for a specific enterprise case. And at the time in 2017, we had to build the world's fastest blockchain. To do that, I knew it would take us a year to 2 years. So you have to really believe that the use case with those customers will actually pay out. So the way that you risk mitigate that is you actually go and talk to those customers and say, when this thing's executed, what are you going to, you get them to confirm what they're going to pay, how valuable it is to them, and get them to sign something, so that like even just the cognitive hurdle of them signing a piece of paper, even if it's not binding, is like, like how close they are. In some cases, if it's a consumer led product, we might spin up a landing page and actually have the buy button and run a bunch of stuff to them to buy, and then just have it fail on purpose at the payment, so that the payment looks broken. So I might do that entirely on I might have the same concept with a different brand name and run an
Wow.
entire campaign just to see how many people actually go to put their credit cards in and try to purchase. And then I'm actually just measuring what the conversion would have been, to know sort of like, if this channel going to be an appropriate channel, where I think that ceiling might be. And so you're trying to like predetermine where you're going to be limited before you ever get going, as part of my investigation process for like, is this business worth it or not? And so on the hard tech stuff, you just have to be really confident that the business will be there, and that the enterprise sales will be there, or whatever you're doing, to be able to sort of invest that 2 years, sometimes 3-4 years in development. On more consumer stuff, it's a little easier, because you can get feedback loops right away, that there is going to be something here, or it won't be here. And maybe you didn't even have to vibe code the whole thing. You said to pretend you had it and sell the website and see if people would even buy that selling proposition.
Yeah, I love that approach, man. Before we go, I got to get your insight on the kind of founders you like to invest in. If you've been working with founders this long, you have to see certain patterns in what makes a founder successful or even a failure.
So it is funny. There are some patterns. I typically don't invest in a founder that just came out of a corporate environment. Like, we've looked at a
Really?
lot of like, ex Amazon, ex Facebook, ex
Investors usually
whatever.
chase those. That's crazy.
Oh, like they're used to working in corporate environments where there's a lot of cogs in the wheel, and they benefit from platform scale. So they have an idea and suddenly everyone gets in line. So it's easy to look like, oh, my idea went from 0 to 100 million. Or I drove X business from 0 to $8 billion in sales. But you did that with sort of this implied capital structure behind you, which is not only distribution channel, but also all of the sort of people doing their parts. And when you have to wear all the hats, can you be scrappy enough to accomplish the same thing? I find that there's also always a really steep learning curve and higher failure rate than you would expect in that first company out of a corporate job. So I typically have to either catch that founder super early where we're writing a check that is like pre-seed specific and we're like, okay, we're going to do this and we're going to just take the bet, or we just pass because a lot of times those guys are the higher failure rates, in my opinion, because they basically raise 1 million and burn 1 million in like 5-6 months, as opposed to raising 1 million and stage gating why they're releasing that capital and sort of building from the ground up. So I'd say that's like the negative side. And the more positive side, one of the things I look for is a ground up market analysis. I hate when people do like the TAM is X, and if I get 2%, it's this. What I'd rather see, and what I saw recently, actually, we just did a kind of a government defense company, and they were like, these are the exact bills that were passed, these are the exact budgets in those bills, this is exactly where we fit into those bills, this is what's earmarked for that, and this is what we charge. And if we only charge what we charge, which we've already got 6 pilots expanded to these exact opportunities, we're worth $5 billion. Like a bottoms up sort of market analysis for their TAM and their addressable market is like really a really positive signal when they've thought through exactly how they're going to be large enough scale that you can fund them, as opposed to a top down, like figuring it out.
I like that approach too, because it sounds like you put in more effort to really get an understanding of distribution and different things like that to
Yeah.
have more of that lasting impact. Man, this was a great conversation. I feel like we got really tactical. I wasn't expecting it to get so technical. But I love having these kind of conversations with the people who have that experience and skill set. So are you an investor that founders can reach out to on LinkedIn?
Yeah, definitely LinkedIn us, or you can, I think, submit even through our website. I have to go back and look again. DV, like sidedoorventures.vc. And then, yeah, reach out. People LinkedIn me all the time. I think they're often surprised that I'll take the time. At the end of the day, I've had 1 million people agree to go to coffee with me. And, not 1 million, but there's been really impactful things that have happened in my life from someone who didn't need to taking a coffee with me. So I typically try to, if I'm available, make the time to sort of meet with these founders. So if they ask me for something or a coffee or 10 minutes, I will gladly do it. I just ask that you come with like a specific ask. So if you have a problem you need solved, or you have something that you specifically need help with, as opposed to like a general meet and greet, because I think it's easier to get tactical and get actually more value out of that time than if you're just trying to say hi. So if you have a specific ask for a specific thing, reach out and happy to sort of help.
Man, thank you for being here and being a great guest.
All right. Thank you for having me.